Then you will find that after you buy the shares, it starts to tank. After a few weeks or even months, you are tired to see this stock never perform. The moment you sell it, it shoots to the moon. Hello everyone. Today, I'm not going to show my strategy to profit in the market. Instead, I'm going to share my 3 biggest mistakes in my investing or trading journey that almost burst my trading account, which lost more than 75% a few years ago. Sometimes, learn from others' mistakes is also another way to be profitable in the market. Avoid these mistakes definitely will help your journey smoother. Mistake 1. Buy the stock based on dividend yield. Initially, my aim to invest in stock is to receive dividend. Singapore stock is a haven for dividend. I heard about REIT is a good investment with high yield, so I look for the REIT with the highest dividend yield. If we look back the data, 2 years ago, First REIT had a dividend yield of 20.6% in year 2020 and 32.45% in the year 2019. Listen, if you put $1,000 in bank, your annual interest may be only $5 to $10. If you put the same amount of money in the first REIT, you can get $206 instead, which is 2,000 to 4,000% more than the bank. Incredible, right? Without thinking much, I bought it and happily waiting for the money to come. Dividend is a good source of passive income. That time, if I'm not wrong, the price I bought was around $1.31. After I bought the shares, the price falls from $1.31 to $1. Guess what? The yield was even higher now. And I think that $1 was a good support, so I dollar cost average it. Here is where the disaster started. First REIT had so much drama and it kept dipping. During COVID crisis, it further dropped. To me, it is okay, as that period was a critical period that almost all stocks went down. I was naive enough to think that First REIT is a healthcare REIT. The COVID pandemic should boost its income, right? A few months later, another healthcare REIT, Parkway Life REIT, had a V-shaped recovery and reached new high. How about First REIT? It dropped even more. Now the price was around 50 cents. Lastly, after I learned a lot more on the fundamental and how to analyze REIT, I decided to sell it and cut the loss. My net loss on First REIT was around $2,000. Luckily, I managed to cut it as First REIT later further plunged to 40 cents and 22 cents later. Yes, I got some decent dividend from First REIT, but the capital loss was so huge that this dividend was like a dust. What I have learned: never look on the yield in investing. A stock needs to stay profitable to reward investors with dividend. If a stock is using high dividend yield to attract investors, this is a red flag alert. One recent example is HiFlux. A good dividend stock must have a consistent positive trend of increasing revenue and net profit. Fundamental of a dividend stock also plays a very crucial role. Instead of dividend yield, distribution per unit or DPU growth is much important. Mistake 2. Control by the emotion, not rational. Look on the biggest market of the world, US. Do you notice that all 3 indexes are always going out in a long-term perspective? Index is always going out because of 3 main factors: population growth, inflation, and index changes. Population growth creates more demand on the stock. Inflation causes the money value decreases, which then increases the asset price like stock. Index changes always replace a weak company to a stronger one. Then, why most people still losing money in the stock market? It is generally believed that 90% of people lose money in stocks. How can it be? Yes, macro analysis, fundamental analysis, and technical analysis are important in stock market analysis. However, I would say that emotional or psychological control on the stock market plays a much bigger weightage to be profitable in the stock market. For example, do you have this experience? You have done the research. wait for the entry price to be triggered. Ding! Then you will find that after you buy the shares, it starts to tank. The red color makes you uncomfortable. After a few weeks or even months, you are tired to see this stock never perform or in a deep red color. You decide to sell it. The moment you sell it, it shoots to the moon. If you experienced this before, you are not alone. I experienced this a lot and pay a lot of tuition fee to the market. Then I realized that stock is designed to make people lose money in the short term. After being cooked and prata by the stock markets, I summarized 3 important points to control and protect my emotion in stock market. Number 1, never buy with FOMO, fear of missing out, and sell with panic. Using Adobe as an example, I have done the analysis and identify Adobe is a good stock. While I am waiting for it to dip deeper, it suddenly came out. On the next day, it went higher again. I was feeling, oh shit, I missed it. I need to buy it now. And I FOMO to buy it. Then, as you can see, Adobe consolidated for quite long time, and most of the time I was in red as I bought at resistance level. Until one day, I'm impatient and close it at a small loss. However, after I saw it, Adobe is hitting new high and new high again. I also made the same mistake on SPGI. Second, buy a stock after listen to a tips or read a news. The tip can be from media, analyst, financial report, or even the YouTuber. It is fine to listen to those tips, but it is still very important to do our own research and wait for the correct entry. Take NIO as example. NIO Day, held on January 9, 2021. Many reports and YouTubers then saying that NIO Day would have a big surprise to push the NIO stock to $100 or even higher. But let us see what has happened indeed. Anyone who purchased a stock during the NIO Day, they are still suffering a loss. Similarly, when Pfizer released its news about scheduled a meeting with US FDA on 10 December to discuss the emergency use authorization request for Pfizer and BioNTech COVID-19 vaccine, many investors are being hyped and bought the shares. What happened next? Whoever bought the share during that day is still suffered a loss. If we do not do enough research on the stock, any correction would induce fear on us and will cut the loss. It is very different if we have done a proper research on a stock that we believe in it. Those who bought the share during NIO Day most likely already cut their loss during the sell-off last few months ago. This is the same for those who bought the Pfizer stock purely based on the news. Only the investor who has done a very extensive research on a particular stock, know its potential and intrinsic value, then they will be able to hold the stocks up and down during the volatile period. And these are the people who can profit from these stocks eventually.